What's going to happen to the U.S. stock market in the second half of March 2026? Will we see a huge breakout rally, or are we heading for a sharp correction that catches everyone off guard? If you're invested in the S&P 500, the Nasdaq, or the Dow Jones, the next few weeks could bring a lot of volatility, but also opportunity and risk. In this video, I'm going to break down what you can realistically expect, the key risks you absolutely must understand, and the smart long-term strategy that protects serious investors. So, here's the direct answer. The U.S. stock market in the second half of March 2026 is likely to stay volatile. The market's movements will be driven by macroeconomic data, what the Federal Reserve is expected to do, company earnings, and global sentiment. Historically, March is a month of transition. Investors are rebalancing their portfolios after the first quarter, reacting to new inflation reports, employment data, and projections about interest rates. So, instead of expecting a straight line up or a dramatic crash, the most probable scenario is short-term ups and downs within a broader, long-term trend. And this is exactly where most investors make their biggest mistakes. They react emotionally to the volatility instead of preparing for it strategically. Let's break this down in a clear and practical way. First, the macro environment and interest rates. The biggest driver of the U.S. markets is still monetary policy. If inflation data comes in hotter than expected, the market might start pricing in tighter policy, which would increase volatility. On the other hand, if inflation continues to cool down, stocks could gain some upward momentum. Remember, markets are always looking forward. They react to expectations, not just today's headlines. Second, volatility is normal. It's not a signal that everything is about to collapse. Volatility is simply movement. The real risk comes from a lack of preparation, using too much leverage, not having an emergency fund, and short-term speculation without a clear strategy. Short-term swings are completely natural, especially during times of macro uncertainty. Professional investors expect volatility and plan for it. Beginners are the ones who fear it. This brings me to the third point, the importance of an emergency fund. Before you start investing aggressively in stocks, every single investor should have a solid emergency fund. We're talking about enough to cover 3 to 6 months of your living expenses. Why is this so crucial? Because when the market drops, people without that cash reserve are often forced to sell their investments at the worst possible moment to cover unexpected costs. An emergency fund turns volatility from a moment of panic into a potential opportunity. Fourth, let's talk about sector rotation and what the big institutions are doing. In periods of uncertainty, large institutions often rotate their capital. They might move money from high-growth tech stocks into more defensive sectors, or shift from speculative assets into companies that generate consistent cash flow. This rotation can create sharp, short-term swings in major indices like the S&P 500, the Nasdaq Composite, and the Dow Jones Industrial Average. But it's important to remember that these indices show the aggregated performance. Individual stocks within them can behave very differently. Finally, and most importantly, a long-term strategy will always beat short-term guessing. Trying to predict the market's exact movements from day to day is just speculation. Building real wealth in the stock market is about long-term positioning, diversification, managing your risk, consistent capital allocation, and maintaining emotional discipline. The investors who win over decades are the ones who correctly predict what will happen in March. They are the ones who have a plan that allows them to survive every March year after year. So, here's the strategic takeaway for you. The second half of March 2026 will likely bring more volatility, not certainty. But volatility isn't your enemy. A lack of preparation is if you maintain an emergency reserve, avoid making emotional decisions, focus on your long-term positioning, and respect risk. Then these short-term market swings become just noise, not a threat to your financial future. Smart investors don't try to control the market. They control their exposure, their discipline, and their strategy. And that's how you win not just in March 2026, but in every single market cycle. Thanks for watching, and be sure to follow for more insights.